Today I would like to analyze Moncler, one of the largest luxury companies in the world. The stock price is down around 15% from the highs in 2025. So we're going to take a look at the financials to find out if it's a good buy right now. The first one we can recognize is the market cap of 15.65 billion euro. We can see here this makes Moncler the 8th largest luxury company in the world by the market cap. We also have a dividend yield of around 2.24%, which we can see here had a very good dividend growth rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, we had a revenue of around 1.44 billion euro. This was a decline around 11% from 2019, so probably related to COVID. Then in 2021, we had a strong growth rate around 42%. In 2022, we had a very good growth rate around 27%. In 2023, we had a very good growth rate around 14%. And in 2024, we had a decent growth around 4%. And then in 2025, the low growth rate around 1%. So overall, we can see the growth is slowing down in the last 5 years, but it's still very good overall. So it's a check here, and we like to see that. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we can see here in 2020, we had a free cash flow of around 0.31 billion. This was a strong decline, around 32% from 2019, so probably related to COVID. Then in 2021, we had a strong comeback with a growth rate around 133%. In 2022, we had a strong decline again, around 32%. This is something we don't like to see. Then in 2023, we had a comeback again with a growth rate around 50%. In 2024, the good growth rate around 7.5%. And then in 2025, the strong decline again around 27%. So overall, in the last 5 years, I would say we not have a really good free cash flow growth. So it's not a check here, and we don't really like to see that. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for our undervaluation. So we're going to take the free cash flow from 2025. 0.67 billion. Then we're going to divide it with the current market cap, 15.65 billion. And then we're going to get the free cash yield for 2025. So the number we're going to get would be around 4.28%. And I think that's a decent free cash yield. Actually is over the 4% that we are looking for. So the check here, and we like to see that. We can also take a look at the future assumptions of the free cash flow. We can see here in 2026 around 661 million, in 2027 around 705 million, and in 2028 I would assume probably around 720 million. So let's take this number, 0.72 billion. We're going to divide it with the current market cap, 15.65 billion. Then we're going to get a different free cash flow yield. The number we're going to get would be around 4.60%. And again, I think that's also a decent free cash flow yield, is over the 4% as well. So the check here, and we like to see that. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first you're going to take a look at the long-term debt. So we can see here 0.01 billion. So that's a very low amount. So we're going to add the short-term debt as well, 0.01 billion. Then we're going to divide with the current free cash flow, 0.67. And then we're going to get the ratio that we're looking for. So the number we're going to get would be around 0.029. And that's a very good number actually. It takes not many days to repay the debt with a free cash flow. So the check here, and we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. And we can see here around 0.96 billion. So overall, I think this company has a very good balance sheet. They have a low amount of debt and a good amount of cash on hand. The next thing we're looking for is the enterprise valuation to free cash ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for an undervaluation. So first we're going to calculate the enterprise valuation. That's the current market cap, 15.65 billion. We're going to add the debt, 0.02, minus the cash, 0.96 billion. And then we're going to get the enterprise valuation, so how much the whole company is worth. The number we're going to get would be around 14.71 billion. So now we're going to divide this number with the current free cash flow, 0.67 billion. And then we're going to get the ratio that we're looking for. That would be around 21.95. And actually that's a decent number. We would like to see the number under 25, so the check here, and we like to see that. We can also calculate this number for 2028 with our free cash flow assumption of 0.72 billion. So we're going to get a different number. So the number we're going to get would be around 20.43. And that's a good number as well. It's under the 25, so it's also a check here for 2028. And I think it's already an indication for a fair valuation right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that especially if the company is undervalued. So we can see here repurchase of common stocks, and we can see they're not buying back a lot of their shares. Only in 2022 we see a small amount here. So overall it's still a check here. But I think they are more interested in increasing the dividends in the next years. Can the Moncler stock be a good buy right now? The stock price is down around 15% from the highs in 2025. So let's start with the positive about this company. I think this company has a good revenue growth in the last 5 years. I also think this company has a great balance sheet, so they have a low amount of debt and a good amount of cash on hand. The free cash flow yield around 4.28% is also quite decent at the moment, and in 2028 with our free cash flow assumption, it could be around 4.60%, which would look even better. The enterprise valuation to free cash flow ratio around 21.95 is also quite decent. We like to see a number under 25. So in 2028 with our free cash flow assumption, it could look even better of around 20.43, which I think is a fair valuation in my opinion. The dividend yield of around 2.24% is also quite decent because we had a good dividend growth rate in the last 10 years. What I don't really like to see about this company is the low free cash flow growth in the last 5 years. This is something very inconsistent. Sometimes the free cash flow decline was around 30%. This is something we don't like to see. But overall, I think this company is interesting. It could already be a fair valuation. But if you want to be sure about this company, maybe under 50 euro could be a better buy opportunity. If you found this video helpful, don't forget to like and comment and subscribe for more content.